Hi there, I'm Mike Coe, and welcome back to the Open Interest YouTube channel. If you have a comment or a question, please be sure to leave it in the section below and we'll try to answer it. And actually, that's what we're going to try to do today. It's going to be a little bit of a different approach than we've taken in the past. And I thought we might use Alcoa earnings as an opportunity to address a couple of viewer questions that we get from time to time, and one specifically, and also sort of walk everybody through the process of different things that we do when we talk about options in these types of segments from time to time. So first, let's take a look at the question, or at least one of the questions that we got. Hi, Mike. Thanks for all of the superlative education over the years on options trading. One of my favorite strategies that I have learned from you is the vertical call debit spread risk reversal trade. I especially like the risk of obtaining a desirable underlying at a discount in order to offset the cost of the upside spread. Can you discuss what underlying stocks and market conditions favor this particular trade structure? Thanks in advance. Okay, so this is a really interesting question. And as it happens, we saw one of these trade in good size on Alcoa, which announced earnings today after the close. And I think an interesting approach to addressing both this question and some other questions we get from time to time is actually to sort of walk through the entire process of how we often talk about names like Alcoa and earnings and trade structuring, things like that. So first of all, Alcoa is up considerably this year. It's up about 45% year to date. Its 1 year return is close to 165%, so up very, very sharply. Now, you will often hear us when we're talking about names that are due to report earnings. We'll often discuss what is going on in the options market on usually the day immediately prior or perhaps 2 days prior. So things that we will sometimes talk about, the implied move. So how does one go about calculating the implied move? The way you would do this, the simplest way to do this really, is to take a look at the nearest dated options. Usually these are going to be weekly options that expire at the end of the week that they're going to be reporting. You take a look at the stock price. In this case, Alcoa was trading approximately $87 as of the close. You take a look at the 87 strike call. How much does that cost? That was about $3.50. You take a look at the 87 strike put, so the same strike as the call that you're looking at. That too was about $3.50. Put those two together, and that is a rough approximation of how much the options market might think that Alcoa would move on average by this coming Friday's expiration, so about $7. Okay, one of the other things you'll often hear us talking about is just what's going on in the flow on any given day, interpreting the flow. So for example, we were taking a look at it. Usually you will see above average activity going into earnings. That was the case in Alcoa. It traded about 2.7 times the average daily options volume. One of the other things you will often hear us talk about is the sentiment of that flow. Were people exceptionally bullish? Were they exceptionally bearish? Now, oftentimes we discuss that and we'll mention, for example, that more calls traded or more puts traded. That doesn't tell you precisely, though, what the sentiment was. And let me give it some examples of why that is. If somebody is buying those calls, so the initiating trader is buying those calls, that could be considered to be bullish. Or if they're buying to initiate new positions and puts, that could be considered bearish. But of course, it's also bearish in theory to sell calls, and it's also bullish in theory to sell puts. So one of the metrics that we'll sometimes use to establish whether the flow was bullish or bearish overall on a day's volume is to calculate what we call the delta. So you add up all of the initiating trades, buying calls and selling puts. Those sort of are long deltas. And you add up all of the sold calls and purchases of puts. Those are short deltas. And then you figure out essentially how much stock that adds up to overall at the end of the day. And in today's case, that was net shorter in the options market by about $10 million. Now, to put things in perspective, that really isn't all that significant. That is not wildly bullish or wildly bearish. And there's one other point I would quickly make too, which is that when we're trying to gauge the options market's sentiment, it isn't really sufficient to look at a single trade or even to look at a single day's trade, although that's usually what we focus on just to get a sense of what's going on most recently. A better way to establish that is actually to take a look at the entire implied distribution, how much that's skewing around. So the important thing to take away from this is that very high options volumes can have an impact on how a stock behaves, because it actually sets market makers up in certain positions where if the stock is rising, they might have to buy more stock to hedge their short options positions, or if it's going down, they may be compelled to sell more stock to hedge their positions. And that can exacerbate the move of an underlying equity in one direction or another. Contrarily, if the options market making community is net long upside or net long downside, their flows into the marketplace could actually compress volatility somewhat. And we've seen this in some of the meme stocks, for example, where there was big flurries of upside call buying in some meme stocks like GameStop and AMC. And a lot of market observers suggested that one of the reasons those upside moves were magnified even more was that there was basically a reflexive effect as market makers went out to hedge their positions and ended up buying more stock, and people bought more calls, and it sort of fueled itself. Okay, but I think that alone is not the only thing that we want to take a look at. Okay, so here's one of the interesting things, and this gets back to that question. The largest trade that we saw today in the market was, in fact, a call spread risk reversal, which is what this viewer was asking about. So why don't we first take a look at, for those that don't know, how you actually construct that trade and what this one was, and we'll sort of walk through it in pieces. So again, this was the largest trade we saw in Alcoa today. It was a call spread risk reversal. It was a little bit different because it wasn't exactly one up, but what we saw was somebody bought 1,600 of the January 2023 90 strike calls. Okay, so if you buy a call, that's obviously a bullish position. It has unlimited upside gain potential in theory, because a stock also has unlimited upside gains. And you're limiting your risk to the amount of premium that you spend on that call option. Now, in this case, as a function of the stock's price, that premium was quite high. It was over $14 a contract. So relative to the $87 price of the stock, you're limiting your risk to just over $14 a share, but that's still fairly significant. So limited risk somewhat, but unlimited reward. Okay, so what's the next step in creating a call spread risk reversal? Well, the next step is that generally they will sell a higher strike call. And in this case, it was the January 110s. Now, normally when you construct this trade, the way it's conventionally described, one would sell the same number of calls that you're purchasing. In this case, the institutional trader here sold 1,500 of the January 110 calls rather than the 1,600 of the 90s that they purchased. What does this do? Well, for one thing, it lowers the overall cost of the trade, because rather than just spending the $14 and change on the 90 strike call, they're now collecting some premium by selling that higher strike call. So it lowers their maximum risk in this case, because they've reduced the amount of premium they spent, but it does cap their gains. And the reason is because your gains are capped at the short strike that has been sold, 110. Now, in this case, it's not completely capped, because they didn't sell all of the same number of calls that they had purchased, but it does certainly abbreviate it. If you take a look at the chart on your screen right now, the small one in the lower right-hand corner, you can sort of see what that payoff diagram looks like. And you can see that there's still a little bit of upside beyond the 110 strike call that they have sold, but it does cap those gains quite significantly. Now, in a risk reversal, you also then add a third leg. And in this case, that was selling the January 60 strike put. Okay, so this does several things. This, again, because you're selling another option, brings in some premium, lowers the total cost of the trade. In fact, in this particular structure, the trader was actually not laying out premium at all. They were actually collecting net premium of about $120,000. So that's obviously quite good. Now, they're going to see profits as long as the stock stays above that $60 put strike that they sold. Now, to put things in perspective, they sold 1,500 of those puts. 1,500 puts at the 60 strike represents $9 million worth of stock. So the 120,000 in premium they're collecting, while that's a nice thing, it doesn't represent an enormous percentage, really, of the amount of stock that they're really potentially going to be taking ownership of. Now, another important thing about this, you're short more options than you're long. So as market expectations of volatility rise, options premium will rise. That would not be good for this position necessarily. Contrarily, if expectations for volatility fall, what we call implied volatility, then that would be good for this position. An interesting thing here, too, is that this trader chose a structure that was fairly far out in time. Usually when people use call spread risk reversals, you're going to try to make it a little bit shorter dated than this. And there's a couple of reasons for that. One of those reasons is that stocks can really move quite significantly over longer periods of time. The chart you're looking at here, the green region shows approximately where this structure is going to be profitable, and the red area is going to show where it would be unprofitable. But bear in mind the scale here. This trader owns the 90 strike and is short the 110s. Those curved lines that you see there represent 1, 2, and 3 standard deviations as currently implied by the options market for how the stock could behave over time. The further out in time you go, the more the stock could potentially move. And we've seen that. Alcoa, a year ago, was in the 30s, and it was close to 90 as of today's close. So usually when people do these types of trades where you're short more premium, I tend to favor using shorter tenors, that is, shorter periods to expiration than this institutional trader did. And that is because shorter dated options will decay much more quickly than longer dated options will. But these are not the only things that people should be thinking about when you're saying, okay, when and how and where do I use a call spread risk reversal? Because maybe the most important thing about this is it's a bullish trade, so you really need to start thinking about the stock more than the option structure. And when we do that, there's a couple things that we want to think about. So first of all, anybody who's watched me for any length of time, I will often speak about the fundamentals. How do I feel about a company fundamentally? So my fundamental view is going to be important. The thing about fundamentals, though, is that while if you have a Warren Buffett-like time frame, that's obviously important to keep in consideration. What we know is that the options market might be a weighing machine in the long term, but in the short term, it tends to be more of a voting machine. So in addition to the fundamental view, we also want to take a look at the technical view. Now, as it happens, I am not a technical analyst, so I will usually rely on the expertise of those that are, but a lot of traders, both retail traders and institutional traders, have their own technical approaches. There are a lot of tools that you can use for this, and we'll get to that in a second. So why don't we start with the fundamentals here, bearing in mind that, of course, when you look at any options trade, you want to pay attention to any catalysts that are ahead, but we know in this case that Alcoa had earnings after the close today. Okay, so fundamentals for Alcoa. Why has the stock been doing as well as it has? Well, one of the things that has happened, of course, very recently is that steel and aluminum prices have really surged since the invasion of Ukraine. So that obviously, as you see the cost of a product that a company sells going up, that's going to be a positive. So that's going to be a tailwind. Even before all of that happened, aluminum supplies were quite tight. And if supplies are tight and demand is high or rising, you're going to start seeing higher prices. One of the biggest consumers and also the world's largest producer is China. China's aluminum demand growth is considered likely to slow somewhat in full year 2022 versus 2021. Number of reasons for this, but obviously we've been seeing a lot of news recently that China's economy and the growth there has been slowing considerably. I don't need to tell anybody who's watching this that one of the big factors that also applies here is inflation. And inflation affects businesses as much as it affects individuals. We've been seeing significantly higher input costs for alumina, for pre-baked anode, for bauxite, and obviously energy prices. So we're talking about both carbon-based and energy and electricity. All of these things are input costs for the production of aluminum. Also, an important element that we see in China, at least, is that they are tightening their environmental regulations there. Finally, they are the world's largest aluminum producer at the moment. Tightening environmental regulations in China could potentially slow the output growth for aluminum on the production side in China. So we have to weigh both of those, so supply and demand. Tightening regulations on the environment there would slow the production side. That's bullish for aluminum. That would be better for Alcoa overall. Okay. So just taking a look at some valuation metrics. If we take a look at enterprise value to trailing 12-month EBIT, it's well above average right now. I think it was just under 19 times as of the close. I think the median is closer to 14, and the mean, which has a tendency to skew a little bit more towards the bigger numbers, was still well below 18. And when you see valuation metrics that are above average, that's indicative of optimism. And that's basically an indication that people who are purchasing the stock are willing to pay a price based on what they anticipate will be better numbers in the future relative to what we've seen in the recent, in this case, 12-month past. And we've just talked about what some of those things might be. So to get the technical view, I pinged Carter Braxton Worth. Those who watch Options Action will know that he's referred to as the chart master, and he's somebody I often speak to about technical analysis. When I asked him about this going into earnings, he said, I'm thinking long. Okay. So since that time, Alcoa actually did release earnings. They did after the close today. And for anybody who's interested, you can go to their website. They publish right on the investor relations section the results, which I'm going to highlight right now. Another thing you can always do is listen to the conference call. For anybody who's interested, I encourage you to do that. And the reason I encourage you to listen to conference calls is because if you listen particularly to the analyst question section, you're going to hear them ask management about the things that they consider to be important. So when you start seeing the stock trading lower after the close, and it looks like sort of the highlight numbers are all good. For example, earnings per share was $3.06 per share versus $2.97 estimated. What was it that actually caused the stock to trade lower? Which it did, by the way. It was trading about $4 lower. So well within the options implied move, it should be said, but slightly lower. So it would seem that those trading the stock, at least after hours, were slightly disappointed by the results. What were those results? At a high level, revenues missed. So they reported just under $3.3 billion in revenues versus $3.44 that the street was estimating. They did have an EPS beat. EBITDA was just over $1 billion. I think it's the first time actually that the company has ever had EBITDA over $1 billion, and the margin was about 32.5%. Now, we're going to see better margin numbers. Why? Because the revenue number was less than expected and EPS was better. So clearly, how does that happen? Margins must be a little bit better. And how were they better? One of the things we saw, aluminum prices were 14% higher. The important thing was, I think, that aluminum sales actually was one of the things that did disappoint people who were taking a look at these results after hours. If sales were up 3%, but the average price of aluminum sold was up 14%, what does that mean? It means they must have sold less of it, right? Because if they'd sold even the same amount, their sales would have been 14% higher, reflecting that average higher price. So aluminum sales actually declined. Some other things that came out, they decreased their projection for bauxite shipments by over 4% for the full year. They expect alumina and aluminum shipments to be basically unchanged. And overall, when I was last looking at this, and it may have changed only very slightly from when I'm speaking to you, the stock was about 4.5% lower. And again, just to put things in perspective, that is within the implied move. So maybe we can go back and take just another quick look at this trade again and think about this. The trader who did this trade knew earnings was coming up. They obviously are bullish about Alcoa because a call spread risk reversal is a bullish trade. Why did they do this trade, though, rather than simply purchasing the stock? And I think the reason for that is that this is a stock that has risen very, very sharply over the course of this year and actually over the last 52 weeks. Take a look at the levels that they chose. This is a trader that wanted to have upside exposure if Alcoa continued to rally as it has done, but was not willing to commit to purchase the stock unless it falls back down to about $60. And you'll notice on this chart that that's approximately where the stock was end of January, beginning of February. And it represents a significant discount to where the stock was trading as of the end of the day, close to 90, right? So you're dealing with maybe a 30% discount to the closing prices where they would be compelled to get long. And they have still $20 worth of potential upside. Now, the way to think about that, by the way, is not because their risk is at 60. That's where they could be put the stock. So when you think about what their potential returns are, their returns over their risk are really 30%, right? Because they could either own the stock at 60 as of next January, or they could essentially own it at the current price. And if it gets all the way up to 110, they'll see $20 in profits. And one other quick point, and this is just something that people ought to think about when they're structuring options trades like this. Be creative, be flexible. In this case, they bought more at the money calls, then they sold puts, or then they sold upside calls. So while their upside profit potential does trail off, if Alcoa runs through that $110 strike price, they will still see some incremental gains. The only thing I would point out is that on a stock that's relatively high volatility, as Alcoa is, that has very big moves over time, as Alcoa certainly can, and as it has over the course of the last year, I would probably have steered this trader towards using something a little bit nearer dated than they did. But that's just me. I hope that helps all of you who are wondering why it is, and we talk about implied moves and how we calculate it. When we talk about color and commentary and flows in options markets going into an event like earnings, don't misinterpret what that is. That's not a signal necessarily to purchase the stock or to sell it, to buy calls or to follow people blindly into what they're doing. We're just trying to give a sense of what people are doing. In the same way that if you turn the news on and they start talking about Tesla trading higher after earnings and that the volumes are above average, that's not necessarily a sign that you should go out and buy Tesla after earnings because other people are doing it. But it is an important piece of the puzzle. It's just a tile in the mosaic, as we might say, as we try to formulate our own investment decisions. This is a little bit longer than we normally go and a little bit more off the cuff, but I hope some of you found this helpful, and I appreciate your time and attention. And if you like this kind of content and the other kind of content that we sometimes provide as well, hit the like button, hit the subscribe button, hit the notification bell. You'll be therefore alerted whenever we put out a new video. Thanks for watching. If you liked the content, please consider subscribing to the Open Interest YouTube channel. That's youtube.com/open interest. And of course, you can also follow or tweet me at Michael_Co, or go to our website, www.openinterest.pro. Thanks for watching.